The impact of the federal government's Treasury bond purchase. Brought to you by Team 3. In order to fully understand what is being proposed here, we must first know what Treasury bonds are. U.S. Treasury bonds, also called T-bonds, are negotiable, coupon-bearing debt obligations issued by the U.S. government backed by its full faith and credit. They are exempt from state and local taxes and have interest that is paid semi-annually. These securities have the longest maturity of any bond issued by the U.S. Treasury, ranging anywhere from 10 to 30 years. Other types of bonds. Government bonds. These are considered the safest of bonds. Municipal bonds. These are riskier than treasuries and have tax breaks. Corporate bonds. These are the riskiest of the fixed income bonds because companies are more susceptible to economic problems than governments are. Zero coupon bonds. These are fixed income bonds that don't make interest payments each year like other bonds. They have a tax drawback if they are not kept in a tax-deferred retirement account or an educational IRA. Out of all bonds, these tend to have the highest yield. Over the course of the next 8 months, the government is planning on buying $600 billion worth of Treasury bonds. The Fed will buy $75 billion of government debt and will buy another $30 billion from its vast mortgage portfolio. The downside to this plan is that the Treasury must print more money in order to cover the purchase, which, in turn, will drive the value of the US dollar even lower. Effects on the economy. Stimulation of the economy is the goal of these Treasury bond purchases. Ideally, the purchase of long-term government bonds will drive down interest rates on mortgages and other debts. The idea is that these lower interest rates will encourage more Americans to take out loans and increase their spending. Also, people with underwater and or skyrocketing mortgage payments will be able to refinance their homes at lower rates, leaving more spending money in their pockets. Greater spending among consumers will lead to more hiring, reversing the almost 10% unemployment rate. Comparison: companies that have repurchased their own stock. Similar to the government purchasing U.S. Treasury bonds, U.S. companies have been buying back their own stock for decades. The goal of the firm buying back its own stock is to reduce the supply of stock, which in turn increases certain metrics that measure the company's financial performance. Companies such as Sprint, Pepsi, Microsoft, and many others buy back stock often. Pepsi, for example, noticed a 1.6 increase in share price after it announced that it would spend as much as $15 billion over the next 3 years to buy back stock. Microsoft followed suit, taking it a step further by issuing bonds to generate the cash needed to buy back its own shares. This jump-started interest in Microsoft shares, which, too, can increase share price. Finally, Sprint found itself under fire after executives were selling shares around the same time the company was buying back shares. A situation such as this begs the question, is buying back shares ethical? Companies argue it's a flexible alternative to paying dividends, while others see the Sprint case as a conflict of interest. Pepsi plans to repurchase $4.4 billion in shares during 2010. Analysts believe that Pepsi is getting a good deal by buying now when stock prices are lower. One glaring failure of the same maneuver is British Petroleum. Between 2005 and 2008, BP repurchased 37 billion stocks to return money to investors. Since the recent Deepwater Horizon exploded and sank, causing the worst oil spill in U.S. history, those same shares are now only worth $15 billion. Another company that tried the same maneuver is Lexmark. Lexmark repurchased 59 million shares for $32 billion. Share prices have since dropped from $54 a share to $15 a share, losing $900 million or 70% of the share value. Unexpected turns in the market or catastrophic events can turn a good plan for companies to spend excess cash into a business nightmare. Prediction: after taking a group conscience, we believe that the plan to buy back bonds is a good idea. It will help spur on spending and hopefully get the housing market back to a good spot. We predict that although it's a good plan for the present, it might have negative implications down the road. At the end of the day, there is a risk in buying back a company's stocks, as well as a risk for the federal government to buy back Treasury bonds. But with the main goals in mind, we have to believe that the benefits are worth the risk.